Hello and welcome to part 2 of the lecture for chapter 13. I'm going to pick up where we left off in the last part where I'll talk about journalizing transactions. And so I'm going to talk through these 11 different financial events or transactions that happen in the company, and then the 4 adjustments that are made. And I'll show you on the next slide how to what the journal entries will look like on each of those. Then I'll talk about posting those entries to the general ledger. I'll talk quickly about what a trial balance is and how we use it. And then lastly, the closing process. So I'm going to switch to the next slide here, and I want you to focus on the journal entries as we come to them. You might want to print this particular slide out just so that you can consult it when you're looking at the journal entries on the next slide. So the first transaction, we acquired $25,000 from the issue of common stock. So again, the approach to doing journal entries for these is to say what categories are being affected. So the categories that are being affected here are assets and stockholders' equity. And specifically, cash is increasing and common stock is increasing. So I know that from my dead clerk mnemonic that assets increase with a debit and stockholders' equity increases with a credit. So for this transaction, number 1, I'll debit cash for $25,000 and I'll credit common stock for $25,000. The next transaction, number 2, we purchased $850 of supplies on account. So what categories are being impacted there? Assets are increasing and liabilities are increasing. I increase assets with a debit. I increase liabilities with a credit. So I debit supplies, that's stuff I own, it's on my balance sheet. I debit supplies for $850 and I credit accounts payable for $850. Keep in mind here, you can see here that every single transaction debits equal credits. That's critical. Event number 3, we collected $1,800 cash as an advance to provide future services over a 1-year period starting March 1. So here we have to remember how we deal with prepayments from customers. This is a transaction where we're receiving cash in advance of earning revenue. So if you remember correctly back from, I think it was chapter 3, we talked about unearned revenue being a liability. So in this case, I have an asset that's going up, cash. I'll record that with a debit. And I have a liability that's increasing, unearned sales revenue, that I increase with a credit. Remember, I owe that money back to the customer until I satisfy their requirements, provide the service for them. Transaction 4, I provided $15,760 of services on account. So in that case, an asset is increasing, accounts receivable, I debit that, and I'm recognizing revenue. I recognize revenue, or I increase revenue with a credit. So I debit accounts receivable and I credit service revenue. Next, I purchased land for $26,000. That's one of those asset exchange transactions. So here I have one asset that's increasing, land, and I have one asset that's decreasing, cash. So I record increases to assets with a debit. So I debit land for $26,000 to increase that account. And if I record increases with a debit for assets, I record decreases with the opposite, with a credit. So I reduce cash by crediting it for $26,000. Next, event 6, I paid $1,200 cash for a 1-year insurance policy with coverage starting August 1st. So in that case, I'm paying for an expense in advance, okay, a deferral. So I'm going to debit or increase prepaid insurance for $1,200, and I will reduce cash by crediting that account for $1,200. This is also one of those asset exchange transactions where one asset goes up and one goes down. Event number 7, we collected $13,400 cash from accounts receivable, another asset exchange transaction. I've got one asset, cash, that's going up by $13,400. Another asset, accounts receivable, the money I'm going to receive from customers, is going down by $13,400, so I use a credit for that. Next, event number 8, I paid $9,500 cash for salaries expense. So in that case, I increase my expenses with a debit. That's the E in dead clerk. So I record a debit to salary expense of $9,500, and I reduce my cash with a credit for $9,500. Event number 9, I paid an $800 cash dividend. So dividends increase with a debit. That's the last D in dead on our mnemonic. So I debit dividends and I credit cash to reduce my cash. Event number 10, I paid $850 cash to settle accounts payable. So I've got two things that are going down here. I've got a liability that's decreasing and I've got an asset that's decreasing. So I record decreases to in an asset with a credit. I record decreases to liabilities with a debit. Remember, I increase liabilities with a credit, so I decrease them with a debit. So I debit the liability for $850 and I credit cash for $850. Event number 11, I recognize $1,900 of other operating expenses on account, so maybe my phone bill and utility bill and things like that. So I debit other operating expenses to increase my expense, and I credit accounts payable to increase my liability. Now I've got some adjustments to record with entries. So adjustment number 1, I need to recognize that $1,500 of deferred service revenue has now been earned, so I can reduce that liability and recognize revenue. So I reduce liabilities with a debit, so I debit unearned sales service revenue for $1,500, and I increase revenues with a credit, so I credit service revenue for $1,500. Now I've gotten credit for that. Next adjustment, recognize $800 of accrued salary expense, so that's wages that people have earned but that we haven't paid yet. So I increase expenses with a debit and increase the liability with a credit. Next, I recognize $500 of deferred insurance expense. So I reduce my prepaid insurance. So if I increase assets with a debit, I decrease them with a credit. So I credit prepaid insurance and I debit insurance expense for the to increase it. And the last one there, we recognize $725 of deferred supply expense. That means we've used up some of our supplies. So I increase the expense with a debit and I decrease the asset with a credit. So I'll do one more problem like this that I'll post as video practice that'll help you with your next homework for sure. So the next thing we can do is what's called posting. So it's taking those transactions and recording them under each account's T account. So we'll do posting in T accounts. It could be done a couple of different ways, but this is the most visual way to do it. So I go transaction by transaction and transfer the debits and credits to the particular T accounts for all the accounts that we had there. So as an example, that first transaction where we debited cash for $25,000 from the issuance of common stock, you can see here there's a little 1 in parentheses next to $25,000 under cash. That is on the debit side of the T account. And then go over 2 columns and you'll see common stock. You'll see a T account for that, and it has the credit of $25,000 with a little 1 next to it. So that 1 in parentheses next to that is what helps us trace something from the posting back to the journal entry where it originated from. Let's pick another one randomly here. Let's see, event number 7. We collected $13,400 cash from accounts receivable. So cash goes up by $13,400. So we debited cash for $13,400. So it's under the left side, the debit side on the cash with a 7 by it. And then we're going to credit accounts receivable. So I'll go down to the next account below that, an asset, and I've got $13,400 on the credit side. So again, for every debit, left side, there's a credit, right side. So it stays in balance. The benefit of this is now you can see where we ended up in some of these accounts. This would be equivalent to the total at the bottom of our transaction grid. So once all these transactions were posted to the general ledger, I can see that I ended with $6,850 in cash, debit balance, which is its normal balance. That makes sense. I ended up with $2,360 in accounts receivable. Debits were greater than credits, so it's a debit balance. That makes sense. That's how much money people still owe the company. Prepaid insurance, I have a debit balance of 700, supplies 125, and land 26,000. You'll notice when there aren't multiple transactions, we don't need to put a subtotal there. It can just stand by itself. When we flip over to the other side, let's take as an example unearned sales revenue, that liability. Notice that the credits are greater than the debits, so I end up with a credit balance here, which makes sense. My liabilities should be credit balance. That's the side we increase them by. So in this case, I still owe that customer $300 worth of services that they had prepaid. So once I post the transactions to the general ledger, the next thing I'll do is create what's called a trial balance. So a trial balance, and in this case you could do unadjusted or adjusted depending upon whether you do it before the adjustments or after, but it's simply a listing of all the debit and credit balances, and it can be really useful in finding errors so that you can make additional adjustments before you actually go to do the financial statements. So the first thing we want to do is make sure debits equal credits. Okay, so here's an example of from this same company where I've listed all of the accounts in financial statement order, so assets, then liabilities, then stockholders' equity, then revenue, then expenses. And I've just recorded what the ending balance was, either in the debit column or the credit column. Add them all up, and you can see they equal each other. So there's a couple of tips. If you do this and they don't equal each other, well then what, right? So one of the things you can look at is if the difference between the two columns equals an account balance, then you likely just skipped an account, okay? Because that'd be the easiest thing to find. If the difference between the two columns divided by 2 is equal to one of the account balances, then you have something on the wrong side. You have it under the credit column when it should be debit, or vice versa. The other thing that's kind of interesting is a little trick. If the difference between the two columns is divisible by 9, say it's 90 or 180 or 270 or some number like that, then it means that you likely transposed a digit. As an example, under cash there, maybe you enter the number 6,580 instead of 6,850. That's an easy mistake to make. The difference then is going to be divisible by 9 whenever there's a transposition of numbers. So that's kind of a helpful trick. So the last thing I want to talk about is the closing process. So we'll look at our accounts and categorize them one of two ways. Some accounts are permanent accounts, meaning that their balances carry forward from year to year. If I have a $15,000 truck that I own on December 31st, then I still own that truck on January 1st. Okay, so it comes over the year-end process. Same thing with liabilities. Okay, so all of my balance sheet accounts carry over from one year to the next. All of the income statement accounts are temporary accounts. And think about it this way. If I pay $1,000 a month for rent, then every month I'm going to debit rent expense for $1,000 and I'm going to credit cash for $1,000. And throughout the year, I want to know what the expense was for the month, but I also want to know the year-to-date expense. I want to know at the end of July that my rent expense year-to-date is $7,000. So that's going to matter all during the year. So I'll carry those balances forward and add to them each month. At the end of the year, though, I want to wipe that slate clean because I want to start January 1st back at 0. So I start with a new year-to-date total. Okay, so this process is going to be how we go about clearing the accounts of all the amounts in them for temporary accounts and closing that to retained earnings. So in this example here, we debit service revenue for $17,260 and we credit retained earnings for $17,260. If you look back on your lecture notes, that was the ending balance in the service revenue account on the T accounts or on the trial balance. So if it has a normal credit balance, which this did, then we're going to want to debit it to zero it out. That'll bring my service revenue account balance to 0. So I debit that, I credit retained earnings. For all of my expenses, they have normal debit balances, so I have to credit them and debit retained earnings. So I do that. Lastly, I close my dividend account to retain earnings. Once I do that and I post those closing entries, I'll do one final trial balance, which is called a post-closing trial balance. That's just to confirm that I don't have any stragglers that I missed. Any revenue accounts that still have a balance, any expense accounts that still have a balance. And as you can see here, I don't. I'm left with just my assets, my liabilities, and my stockholders' equity, which are my permanent accounts that carry over from one year to the next. So I've kind of put the accounts to bed, if you will, at the end of the year, and now I'm ready for transactions for next year. So that's the end of the lecture for Chapter 13. Thank you very much, and as always, please don't hesitate to call or send an email if you have any questions, and please do look for the video practice for problems similar to your homework. Thank you.